All right, so earlier today, I mentioned how the NASDAQ had yet to make its lower low in concert with the S&P and with that of the Dow. I took your attention in here to these two wicks, and it was happening pretty quickly, so I know that you probably didn't appreciate or could appreciate what I was trying to draw your attention to. If you ever have, this is for your notes, and again, you'll see these things form in your back testing, and you also see them form going forward as well. If you ever see a big down candle like this, what makes it big? Look at the candles before it. Relatively speaking, this is larger compared to this one here, right? And all these over here. So there's a lot of what? Displacement to the downside. Is there a fair value gap in this? Not on this 1 minute chart, it isn't, no. Nope, it's not. But look closer. Real time, I try to take your attention to it, and I know it's in the recording when you play it back. I told you to take a look at this wick here and measure it, eyeball it, find the consequent encroachment of that wick, and then the consequent encroachment of this wick. I'm going to show you what the algorithm's referring to here. Okay. Between the consequent encroachment of this wick at 12,264 even, and the consequent encroachment of this wick here, which is 12,248.25, that right there is equivalent to what? A fair value gap. Oh my goodness. Oh my goodness. We're getting to the good stuff. Not yet. It's getting better as we go. So this price point here, right? I know this thing likes to jump right to I'll draw it away from it. We'll get close to it that way. Okay, and then this one has to be on 258.25. Right there. So right there is equivalent to a fair value gap. Now you don't see it. You don't see that in charts. And when I talk about things that are not in the chart, this is one of those things that signature is referring to. What can the wicks do? Color outside the line. That's where the damage is done. Outside of this implied fair value gap, because that's what this is, making sure it's in your notes, label as such. We don't have a separation because if you look at, I'm going to extend this over so you can see there is no distinction between this candle's low and this candle's high and only having this candle's range noted like a typical fair value gap would show. Both of these wicks overlap each other and offer no gap on this one down closed candle. But because we have two long wicks, this here on this candle, and then we have a long wick or tail on this candle here, you split that in half on both of them. And you use both consequent encroachment. Now, imagine me trying to teach this tonight. Okay? Say you didn't watch me refer to it live. I never mentioned it, never drew your attention to it live, and I opened the comment section up. I guarantee you, I'd put $10,000 on it. I'd probably have 50 people say, this is cherry picked. This is all conjecture. Nobody would have known. You couldn't have said that was going to happen because you never saw it in a book. Nobody's ever talked about it. But I took your attention to it live as it was happening. Now, with the benefit of knowing what it is that you're supposed to see in it, look real close. What do you see? Isn't this just like a fair value gap? You might get a little bit of a mohawk above it, okay, because you want seamless price delivery. Where does it really go to? The order block. What's the opening on that? 12,268.5. What's the high on that candle? 12,268.75. One tick into it, this order block. Then the bodies are what? Where are the bodies forming? You want to know what I'm looking at when I'm reading price, when I'm looking at fair value gaps, institutional order flow, entry drills and things? The benefit of knowing where the bodies stop. Ready? Midpoint is here. Did the bodies even reach and touch the consequent encroachment of this implied fair value gap? No. So it's doing what? The bodies are telling you the story. The wicks are the damage. Okay, it's always going to go outside the lines. But the bodies of these candles are telling you and indicating that it can't even close or open on a new candle at the midpoint, which is consequent encroachment of a imbalance. Even though this doesn't look like it's an imbalance, I'm teaching you what the algorithm is seeing at that moment. What levels is it going to refer to? The midpoint. But if it's saying, no, I'm not going to rebook there, the composite man sees that as a signature to say, okay, we are decidedly weak. Now aim for sell side. Because even though the wicks went up there, retail sees this stuff, while it was a bold-faced candle, bullish, they're going to trust it's going to go higher. Go back and listen to the recording at this time right here. I said this is where you want to see NASDAQ come up here. Watch these two wicks build the consequent encroachment on both those wicks. Watch that, because it's going to want to do what? Catch up with the lower low that was formed in ES and a lower low in Dow. So your setup would be where? Even though we're not trading NQ, I said this is how you would use this and study this one. And it did exactly what we said we were going to see. Lower prices. But the fact that the bodies were unable to book at consequent encroachment, which is the midpoint of that range, that was the signature that you're not seeing in books. Elliott has no idea of it. Gann has no idea. Wyckoff had never heard of it. Supply and demand, no, nothing. None of that stuff. The fact that it failed to get to that level when it's likely to go for sell side below this low here, make a lower low, when everything else in the market was indicating it should do it anyway, your eye goes right there like I'm teaching you like mine does. It should have what? It should have went up higher. And if it did, then I would have to wait for another subsequent fair value gap to indicate what I'm showing you here. The fact that it can't reach up to a level that it should reach, which is midpoint, it's showing you it's exceedingly weak. Even though the wicks did this, I am not tripped up by the wicks. You're going to hear that all year long. The wicks are going to distract you. They write books about those things. This is a doji. Look at this here. Look at this length of this doji versus this length. That's all conjecture. The markets are not booking on the length of these wicks. Consequent encroachment, or 1/4 of that wick, it is. The equivalent of this not reaching the midpoint and indicating to us as traders that it's decidedly weak is indicated in the same way we looked at with the dollar index. Think of that level as the midpoint of the implied fair value gap that I was just showing you in NASDAQ. Conceptually, just think of it as the same thing. Like this is what it would be. And it went up real close to it, didn't it? But then it stopped. Well, the fact that it couldn't get there is what? Failure. So if it's going to fail to run this, what is it likely to do? Go the other direction. But if you already have an inclination that it's going to go the other direction anyway, which is what I was tapping you real time, saying, look, NASDAQ is going to form it next because it's right now it's the leader, but it will fall sick. It'll become ill and fall to the same plague that caused the NASDAQ to rally against, where Dow and ES went lower, made a lower low in the day. It had already made lower lows. NASDAQ hadn't done it yet. So it's going to be playing keep up with the Joneses. It's going to hurry up and run, try to catch up and bring back symmetry to the marketplace, when at the time, NASDAQ was not showing market symmetry. So much like this here is failing to get to a buy-side liquidity pool, where did it really fail at? Where's the bodies? Look at the close on this candle, and where's the open on that candle? Where is it occurring? Consequent encroachment. What it does not do in price is many times much more important than what you see it do in price. the things that are not in the chart, that's not drawn to your attention with books and courses and nonsense, that's the stuff that's going to creep in and you're going to fall victim to it. And I'm teaching you how to see it, anticipate it. And when it forms, it gives you greater insight about where the price is going to be delivered later on. You're predicting the future with things that you can't find in books. That should get you jacked up. You should be all vibrating right now. Because this is stuff you ain't supposed to know. You ain't supposed to know this. And it happens every day. And now you know what it looks like. You can go back through your charts and your jaw's going to drop. It's been there all this time. And no one's ever told you. It's fun. It's fun, isn't it?